We are live today with Ask Me Anything. I'll kick it off, I guess. I'm up here in New York. I love your hat, Linus. It's pretty sweet. Oh, I love yours too, Carson. Yeah, I don't know. Excited. Doing new stuff today. Fun stuff.
Awesome. Welcome. We're at another Ask Me Anything Wednesday. Thank you for being patient. Shauna rocked the intro. I love that color. I don't know what color is that. Pink, magenta. I think that is a magenta. We're going to have, there is Snaggy. Mr. Snaggy is in the house. So we're going to have some fun. We got some people in the hats. Let's go around the horn and everybody introduce themselves. Let's start with Mr. B. Fouts up there.
What's going on? Brian Foucher up in Washington State. Some nice weather up here right now, and having some pretty unique calls this week on infinite banking from a webinar I did here last week on it, and loving communications, loving solving people's problems. And with that, I'll pass it over to Mr. Linus.
Hey folks, Linus Knoll coming at you from Western Kentucky, Hopkinsville, Kentucky, like usual, knocking out some work. Having some mindset struggles the last couple weeks, just being raw there, but always moving forward. I'm here and happy to answer any questions and things that I can help with. Pass it down to Carson. Right there.
Yeah, what's up, guys? This is Carson Herleen coming to you guys from California. I did a webinar last night with my dad's company. His company is Horizon Trust Company, where they talk about self-directed retirement accounts. And we did a webinar last night together for all of his community, talking about how to self-direct and be in control of your money in terms of qualified money and retirement plans, and in terms of non-qualified money and life insurance. And so we had a good back and forth last night, and it was fun to hear people's perspectives in the comments as well, from people who have policies and have retirement accounts and how they use both of them for their real estate deals, their lending. It was really cool to kind of combine all the ideas together and just have a good conversation about it. So if you guys have retirement accounts and have questions about that, I'd love to answer them. But we're here to answer, obviously, your questions about infinite banking and anything with money. So I'm here to help today. And let's go over to my guy, Jason.
Awesome. Thank you, Carson. That's amazing. Every time, man, I get more and more impressed with just what your depth of knowledge is, how your father is raising you. Linus, thank you for being vulnerable over here, there, being vulnerable earlier. I mean, we all get in those spaces. So that's not something for everyone here. There's two sides of money, right? There is your math, which we love our spreadsheets, but there's also the mindset. So we always want to be aware of where we're at, what are stories we're telling ourselves. Like Linus shared earlier, that takes a lot of courage. That shows true leadership. So when you're here, ask the questions. There is no question that we won't answer that are too, that seem too simple or what. Like tomorrow, come to Founding Fathers, find out if, infinite banking can be taught to a fourth grader. Taught by a fourth grader, taught to a fourth grader. That's what we discuss tomorrow. Make it as simple as possible. Because if someone's making it more complex than that, that means they don't want you to understand it and they don't want you to be in control. So think about that. And over to my buddy, Mr. Joe Helock, this way.
And that's what we teach people, right? Pay yourself first and be in control.
Love it.
Some love from today. Oh, by the way, everyone, before I get in trouble, today is 15 years ago today, I dropped Connor off. This is my fun fact today. We dropped, not Connor, Diego off at school, first grade. He drove to St. Augustine. Patty got dressed in the car in her pretty dress. We went to the courthouse. We eloped. We celebrated. We came back and picked them up from after school. So 15 years ago today, I got married to my amazing Ecuadorian goddess. So
I love that. Congratulations.
I know. Why didn't we mention that, guys? We're failing as friends. That was.
Well, I've been putting it everywhere today, so I'm already, you guys already acknowledged me enough. I just wanted to share that when I saw her name pop up. I'm like,
I love that.
So.
It's awesome.
All right. Well, you know what's super funny though is that we have no questions, so perfect time to chat about it. And then Uncle B Rad pulled over to say BYOD, bring your own disclaimer. Uncle B Rad, and he's back on the road now.
Awesome.
But
Uncle
no,
B-Rad's so creative. He's so fun. So for everyone here, fun energy opens listening. It really, like, think about any great speaker you've ever seen. It usually starts with someone making light of something, either of themselves or of a situation or of the economy or of our human nature. So fun energy. Thank you, B-Rad. You always bring something awesome, bring something funny for us. We appreciate that.
Love it.
I love it. Actually, if we have no questions, maybe we could give them a little behind the scenes. Like, what were some of your, like on Friday morning, we talk about challenges and opportunities. So maybe we could do a little bit of share time today until we get some questions.
Yeah. We talked about something here in the group called just a bit ago that is interesting. And a lot of people don't understand that if you have a business that you can insure your partners. So this is something that's been coming up in my conversations recently, is that people have a business, they have partners in that business, and they're trying to understand how they can put a policy on their business partner. Does it make sense? Why would they want to do that? And so something to keep in mind is that if you have a business partner, you're running a business and something happens to one of you, what happens to the business? Like, it's always something to keep in mind. So oftentimes we don't want to be in business with our partner's family. But if that something happens to that partner, then their family has to step into the business. That's usually not a very good scenario and is not usually what we want to have happen. So with infinite banking, you can have a policy on your partner so that if something does happen to them, you can buy them out. So like, you're the beneficiary of their policy. Something happens to them, you buy out the family. Okay. So you buy out the family so that they're taken care of, and you have some funds to go essentially replace that partner if you need to. That's something to keep in mind. But you have the policy infinite banking in place. At the same time, you can leverage it in the business, like a line of credit, paying employees, buying equipment, buying materials. You can essentially become your own funding in the business as well. So I had that conversation twice this week, and people didn't realize they could do that because they had some trepidation about their business structure and about what I just said. One partner has another partner that has dementia, unfortunately, and they need to exit that partner, but they don't know how. They've got to pay out that partner, but they don't really want to just pay cash. So what they're going to do now is potentially have a policy on them. They'll run the money through the policy first, then use that policy to fund the retirement of the other partner who has dementia and is going to leave the business, but still keep that money in the business for down the road. So it gets kind of a little bit, not complicated, but there's multiple levels to what I just said, but we're solving problems. That's the thing we're doing here. And I love doing that. That was an amazing conversation because the other partner now is going to have the policy on him. They'll pay the loans back, but he now has a retirement plan in his policy that he never had before. So we're solving multiple things at the exact same time. So just kind of want to share that because a lot of people don't really think about the business side of infinite banking, that you can use it in the business side as well. So a lot of cool stuff.
I love it. And then,
Something I did a few weeks ago, I can share about real quick. So I have two policies, and I was aware that, I mean, obviously they're designed for the ongoing premium that I wanted to do, but I got a tax refund for once, and it was kind of an unexpected chunk of money. So hey, what am I going to do with it? I've got plenty of places to put it to do this or that, but I wanted to run it through a policy first. And so I checked with the insurance company, and hey, sure enough, one of these policies has a little bit of extra room. And so I was able to put about a quarter of my tax refund into the policy over and above the ongoing premiums. So that felt like a good win.
I like that. There's a question that came in.
Yep, we just got one right now. Also, real quick, shout out to J10 has a call with Steven Alonso in a few hours, so that's great. Steven Alonso is from, if you've heard of Pace Morby, I know he's in Pace Morby's community and stuff like that. So you have a good call there. Okay, so this is a question for Joe. Does a home have to be covered by homeowners insurance to be able to open a HELOC? What if property is in bad condition, for example, a terrible roof, like unable to pass an inspection?
Then it won't be a HELOC, because the HELOC you're going to get, it's going to be your primary residence. Is this your primary residence that needs a roof? Usually, if you're going to have homeowners insurance on something that has a mortgage or would need a HELOC, so yes,
Okay.
because the bank needs to get, be in control too there a little bit.
And they did say yes, it is the primary.
And then, so yeah, it's going to still need home insurance though.
Okay.
Yeah, the bank's going to require that before even giving it, right?
Yeah.
They have no mortgage, no insurance, paid off property.
Paid off property.
There's Raymond again. Raymond, I got an update for you, by the way, too. I seen her reach out to you.
And then Eve just said that, she had a HELOC on her rental and it required inspection.
Yep.
So I guess if you have your house, it's paid off, you have no mortgage, no insurance, it's in bad condition though, but like,
Good.
what would your next step be?
So then I wouldn't go with a first lien HELOC. I would just get a second lien HELOC, because there's not going to be a closing cost with that. But then once you apply for that, they're going to want to see that it has insurance on it, just in case something happened to it. Then the business would have insurability on that.
Love it. Thanks, Joe. Also, I love Raymond. Brian, you got him.
Yeah. So Raymond, by the way, is approved for a policy, but then we had to go back to underwriting for some new numbers. So with Lafayette, so we're having to go through the underwriting again. It should be quite a bit quicker, but I'm just looking at your notes right now, by the way. So.
Okay, perfect. So we got a two-part question here. So Eric is saying, I'm trying to get the hang of the mindset. I start a policy. How much of your paycheck does one typically sweep into the policy versus keeping in regular checking? And then Chris, I don't know if you could mute the iPad or something like that, because there's a lot of feedback going on.
Oh, it is mute. It is muted.
Oh, okay, no worries.
I think it is.
It's okay. I just feel like I hear myself, but that's
It's
okay.
always listening.
Your audio is a little metally today.
Mine is.
No, not yours. You sound pretty good. Shauna's sounds a little bit echoey.
Yeah, I'm trying some new things here, clearly. So I'm just trying to read comments from the iPad, but it does say that the mic is muted. So
You sound fine.
Yeah, maybe it is just me then.
is anyone else hearing like a reverb or anything else?
On Shauna.
Weird.
On
Sorry,
Shauna.
guys. Cool. Somebody else should read me.
So, so I actually didn't screw the tech up.
There you go.
No, you're doing great, Chris. You're doing great.
But to answer Eric's question, I'll take a crack at this one. So you shouldn't put everything through the policy. And to be honest, the insurance companies don't want you to do that either, because that would put them and you, by the way, at risk. If your income changes, then the premiums are in danger of not being paid. They won't let you do that because that would be risky on them. Now, when we talk about funding infinite banking, what we look at first is money or cash flow coming in that you have going towards savings, going towards maybe it's a plan, a retirement plan, something like that then you can redirect into infinite banking. So that's kind of like the first step, or the first option, because then your cash flow doesn't really change. You're just redirecting some of the money that was going towards this bucket over here to the infinite banking bucket. And that's the first step. You just want to talk a little bit further on that one?
No, Brian, that's great. I mean, really, Eric, it's the mindset shift of when every other insurance that we look at, whether it's car insurance, home insurance, either medical insurance, it's always, I want the most coverage for the least amount of money with a reputable company. It's an if I get in an accident, then my insurance will cover the car. Where when you learn more about this, as you keep working on that mindset shift, it's like the feeling of getting a paycheck. Like, how does everyone here feel when they make money, when they get paid, when they see money go into their bank account? Typically, it's pretty exciting, right? We get pretty happy. We're like, oh, now I can, pay my bills, or I can get this thing, or I can go get a new whatever we're looking to get. It's usually happy. So when you're making the premium deposit, into your account, the feeling there is like, oh, this is for me. This is for my privatized. I'm taking back control of my money. So that's one thing on the mindset front of it. And then as far as like Brian's dead on, as far as the amount you can contribute, eventually over time, the number one thing we teach is think long term. So over time, you want to have all of the money that you have in your family running through your policies. But it's going to take time. It's going to take multiple policies because the insurance company will only improve you up to a portion, like 20 to 25% of what your gross income is, to be able to put into the policy. And then it's also based on age, your earnings, and other things, how much coverage you can have. Because at the end of the day, we're building you a privatized banking system that just happens to have whole life on the end of it, have the legacy, the guaranteed piece. But it still goes by the fact that it's whole life insurance.
Yep.
So we don't have a ton of questions right now. I actually have a really good analogy that I learned from someone that kind of explains this question too. So if you guys don't mind, I'm going to share something real quick.
Yeah, please do.
So basically, it's another person who teaches infinite banking, and he talks about the 4 stages of IBC as a user, and at what point you're doing this concept. Some people are just starting out, learning how it works. Some people are all in, running as much of their money through the policy as possible, and everything in between works. It just depends on your situation, what you value, and what your cash flow looks like. So the way he explained it, he put it in four groups. Here you go. He puts it in 4 groups. I don't know who this guy is, honestly, but I was scrolling through and found this, and I loved how he talked about it. So he shows the 4 stages of IBC. If you're a saver, you could be a capital builder, you could be an entrepreneur, or this could be your lifestyle. And he shows, like, if you're just a saver, you're just looking to diversify a little bit, put some extra money in here. You don't really use it that often. Like, it's just a way to put money away. He says there's no intentionality or a real objective with the policy. This is like the very, very beginner stage of learning infinite banking and just putting, $300 away into a policy along with the other tons of investments and places you put money. And that would be kind of the first stage of doing this. And after I go through these guys, if you guys have any thoughts on these, stop me. But in the second stage, he has the capital builder, and he says this is where a lot of people start. This is where you're redirecting a good amount of your cash flow through the policy. You're intentional about how you use the policy. You're going to do your cars, education, investments. You're going to start using it. And this is how I would say 99% of our clients do infinite banking, is they start being the capital builder. And once they reach that level and they're doing this and they start loving it, wanting to do more, now it's the entrepreneurial level. And that doesn't mean you have to be an entrepreneur. It just means that's kind of how you use the policy, is you're putting every investment, every big purchase. Your business uses it a little bit if you have one. You're trying to run as much of it through the policy as possible. And I would say this is the cap for most people. Entrepreneur stage is where most people max out of using their policy. And that's really where your goal should be when you really get into it. But he goes one step deeper into it. And he shows, this is your lifestyle. This is, hey, I have 20 grand a year of taxes. I do 20 grand a year of charitable giving. And you run everything through the policy. You have more premium than you have surplus income. And you're going to run your charitable givings and your taxes through the policy. You're going to run some expenses through the policy. And the reason you build a policy to do that is because that you're going to get windfalls of money here and there that you can always pay your policy back with. So it's dependent upon your situation to even get to that level. But I'm going through this quickly as well. It's an 1.5 hour long video where he explains each thing in depth. But I just bring this up because this is kind of the conversation we're talking about, is how in-depth do you want to use this? Should all your income go through? Should it not? You can do it at any level. And it just depends on where you're at and what you're looking to accomplish. So you can always have one policy that's small, figure it out, get another policy and step up a little bit, start using more, and you can even expand on that too. So anyway, did you guys have any thoughts on that, the stages?
I think it's awesome. I think it's awesome. I love because it's like any new skill we learn, it's forming a new habit. And it's because 95% of our days are already decided, which is crazy to think about. But you have a habit. Like anytime you want to do something new, you have to let go of something old. So if you're going to adopt infinite banking, like I talked to a gentleman today who he pretty much wants the the glorified savings account for when he wants to retire in 8 to 10 years. It's not, that he has an intention, retirement, but he doesn't have the intention of moving the money, of keeping it in process. And he's been around the campfire for 3 years. So he kind of fits right in between that first and second bucket you're talking about. And so as you're building new habits, and this is back for Eric, right? That was his name. As you're building new habits, just give yourself permission that you don't know everything yet. And as long as you're open to being curious and creative and rethinking your thinking, you can progress like any skill in life. Because what we teach is a process, it's a skill. So that's why I loved about what you shared, Carson, is you can start at any point on this, whether you're dipping your toes in the water, wading up to your waist, or jumping in the deep end. But no matter what, we're going to help you solve the problem in front of yourself, and you decide. Because we're teaching you how to fish, we're not doing it for you. You decide, hey, am I going to be a lifestyle person? Am I going to find a way to pay all my taxes through this, right?
Yeah.
And then make money that way and keep all the money in my family. Because eventually all that money is coming back to you anyhow, because you're getting a multiple guarantee on the money. So if you have it set up on the back end for your family with estate planning and everything else, it's all staying in the family anyhow. So
Yep.
I love it. Can we use that frame that you just said, Carson? Those that like keep on that same topic, because there's two questions in the chat that I feel like if we stayed in this frame would make a lot of sense. So one, Tanya is saying, hello, everyone. I'm new to all this information. How and where do you start? And so to that, I want to say, one, you have the little YouTube emblem right there. So I know you're commenting from YouTube. And so the Chris Noggle YouTube channel is definitely a really good place to start learning about it. And then when you're ready, if you feel like you're ready to jump from there, you would then book a call with us. And then to that same point, Jay, I want to do a little, let's collectively help our friend Stephen Alonso, who has a call with this person later today, right? And these are the questions that Jay is asking right now, okay? So Jay is saying, can you explain the 90-10 versus the 60-40 if you're doing a 15-year pay? Which one wins at the end, and how does one apply to the other? And keep in mind, this person asking has a call later. So we want to set up Jay for success later so that he has his mind right for this call and for what he's about to take. And then, Stephen can...
And Jay's been around the campfire for a long time, Shauna, so it's a great job setting up this frame. I think, Jay, the one thing, and you've heard us say this because I know you've been on some of these calls. I see your name. You're always asking questions. You're super involved. Depending on what you're looking to do, it can be a 50-50 and outperform a 90-10 in year one. Because a lot of times in 90-10, you're not even getting 90% of the capital if that was the case. You might have like 88%. But we have some of our cash designs where, you're overfunding it, you're adding lighter fluid on it, where you might have 90, 91%, 92% in year one. So over the long term, the 60-40, we need math to tell you what it would be, but most likely the 60-40 is going to outperform it because you're going to get to the point where your paid up additions are going to fall off. You're just going to put the base. So you're putting 10% of whatever that number is, that premium deposit is in year 7, 8, 9, 10, 11, 12, 13, 14, 15 in a 15 pay. And in that scenario, you're putting 40% towards the base when it's giving you the biggest return. So after around year 10, you're almost getting a double return, like a 200%. So most likely you're 60-40, but going back to my original point to bring it kind of full circle, the design doesn't matter so much as far as what is your goal, what are you looking to do, and we'll design it to make sure that it performs both in the short term for you and over the long term. But it doesn't matter if it's a 50-50, a 60-40, a 65-35, depending on how you're doing it, unless you're giving us specific numbers. I don't know, Linus, you're a math guy, Carson, same. Like, what are your thoughts on that?
This one just came up actually for me. And someone was like saying they wanted 90-10. They were really focused on 90-10. Oh my gosh. I'm like, okay. So I showed them a 90-10. And their first response was, why is the amount so small down the road in 20 years? I'm like, because you're limiting yourself on how much you can put in on the long term. And they're like, what? And I said, I said, let me show you a 70-30, by the way. Very rarely do you do 60-40. This was purely just a premium. 60 or 70-30, also like saying, well, there's so much more money in there. I'm like, exactly. You can leverage more money now down the road into other things. And they're like, and I was like, or you can do multiple policies too. I said, but then when they saw the math, as we talk about, it's math, they were like, oh, then it kind of clicked. And so to back to what Jason said, it depends on what you're trying to do. Like this person wanted to have as much money in the policy as possible, but they were only thinking very, very narrow short term. When we focused on the long term, all of a sudden they saw what we're talking about and what Jason's talking about. So they didn't go with a 90-10 because it wasn't going to do what they wanted it to do. So,
and I'd love to add on that, like from somebody who, I'm not an agent. I'm like a customer or consumer, like everybody else that you end up talking to on the phone, but I have 3 policies. Mine are built, I think my newest one's like a 50-50 and otherwise they're 60-40. And so I really think if you're leaning towards a 90-10, it's, to me, I feel like it's that you don't know what you don't know yet. And like, I don't know what I don't know yet, but I know that as the years go on, I'm going to learn more. I'm going to have new opportunities for investments and stuff like that. So I kind of built my policies around like my actual life. I feel like a 90-10 might work for somebody who has something that they need to do tomorrow, correct? Like that's kind of the person that might need a 90-10.
Well, so that's good point there, Shauna, because here's another person that is going to be doing 90-10s. This is the person that has lump sum of capitals coming in all the time. Their income is very inconsistent, but they get these lump sums. So what they want to do is have as much money going up front and as small as possible premiums in the long term. So they're all about the large amount going in year 1 and as little going in year 2 through whatever. So they're going to be doing multiple policies, all like every year, every 2 years, they'll do a policy. So they're going to be doing big chunks, small premiums, 90-10. They don't have a long-term number. They're just trying to dump these big chunks in.
And Brian, another thing that Jay's saying here, and I agree with everything you all said, and we made videos on this too, and we showed the math and everything else. But to what Jay's saying about the 15 pay, I've been hearing this a lot lately. It's just there's somebody out there talking about the limited pay whole lives, and I have no problem with them. I think they're great policies, but the question I always ask somebody when they're talking about a 15 pay, a 10 pay, or whatever limited pay policy is, how much money do you want to put into your bank? How much in deposits do you want to put into your bank? The answer is always as much as possible. So with a 10 or a 15 pay, that's not the answer. That's not what you can do. You can't put in any more money after the 15th year. And some people would be like, oh, that's what I want. I don't want to put any more money in. So you're admitting you don't want to put any more deposits into your bank. So in 15 years from now, you don't want to save any more money, because that's what they're saying, but it's just the mindset is the problem. And the other thing too, most people don't realize, the way we design the policies, we give you the ability to fund the policy. There's a couple of variations, but at least till age 90 or 95 is typical, but some of them you can fund all the way into the, after 100 years old. But some people would be like, well, I don't want to be responsible to fund it that late. I don't know if I'll have the money. Great. Every policy we design gives you the ability to stop all premium deposits anytime after the 10th year. It's called you can basically reduce pay up your policy. So by reduce paid ups, what you're doing is you're basically telling the insurance company, hey, I no longer want to fund this policy anymore. Just give me a paid up policy. The cash value will continue to grow. The death benefit will drop, and you will never be able to put another dollar in. Essentially, it's the same thing as a 10 or 15 pay, but you hold all the control and you hold all the decisions, because you get to decide when you want to stop making deposits, if ever. But for me, and I think everybody else on here, I would speak for them, I don't think there's anyone on here that would ever want to stop putting $1 into their policy when they get $2 back, or stop putting $1 in when they get $3 back, or stop putting $1 in when they get $4 back, because that's what happens. So after the 15th year, 17th year, 28th year, 25th year, the compounding effect is multiplied by so much that literally every dollar you put in, you're going to get several dollars back. Now, if you tell me, Jay, that you don't want to get $4 for every dollar you put in, great. The 15 pay is an awesome option, but I don't think that would be the answer. So don't do the limited pays, because it stops your ability to fund your banking system. And I can tell you, in 15 years from now, if you apply everything we teach, there's no way you would want to stop funding your banking system.
Yeah.
And Chris, can you speak to, just for all of us? I mean, you're everyone here at some point will be Nelson Nash Institute, right? Certified, an IBC practitioner. That's something that you just, congrats, you just got your certification. You went through the giant binder, the book, the teachings of Nelson Nash, and they talk about a 90-10 there. This is one of the first things you taught me, but I'd love to hear you explain that to Jay a little bit and all the rest of the audience on just why a 90-10 over the long term can actually put you in some other situations that you might not even be thinking about. So,
well, yeah, they very firmly steer IBC practitioners away from 90-10s. They can't tell you can't do a 90-10, but they can tell you, if you're going to call yourself an IBC practitioner, if you're going to hold yourself out there as an IBC practitioner, you're not doing a 90-10. And there's a couple of reasons for it. Number one, a 90-10, by its sheer nature of design, because of the MEC rules, requires term insurance. If you're putting in any significant money into a 90-10, you're going to have a term rider. Now, I'm not saying that's terrible. We put term riders on policies with dump-ins all the time. But with a 90-10, that term rider is almost going to be essential. So what'll happen is eventually you'll have to get to a point where you're going to drop the term, which on all the policies that we design here at the Money Multiplier, we drop that term insurance in either the 8th year or the 10th year. And the reason we drop that term rider is we no longer need it to satisfy the IRS limits, the MEC limits. So why would we want drag on our banking system? We wouldn't want, think of it as a hole in your boat. You don't want a hole in your boat that leaks a little bit of water, every time you take the boat out. You want no holes. So the term insurance, we use it only to satisfy the MEC rules. With a 90-10, when you drop that term rider, just like Brian was mentioning, if your premium deposit was 10 grand in a 90-10, then that means your base is going to be like $1,000 to $1,500. So when that term rider is gone in the 8th or 10th year, you're gonna drop down to funding it at the base limits, which is 90%, 85 to 90% less than what you want to fund it at. Exactly the moment when the policy is hitting its most efficient point in time, when you want to put as much money as you can into it. Listen, just this week alone, I've gotten 3 clients of mine that called me, all wanting to put more money into their policies than what they initially set it up. And unfortunately, like when I went to the insurance company and asked how much more can we put in, one was like $2,200, one was like $1,300. This guy wanted to put like $400,000 more into the policy. So I think, that's the thing. If you do a 90-10, great. You're going to have a little bit more cash value in the first year in some cases, not even in all. If you got dump-ins, like they were saying, you can get better results out of a 50-50 with a dump-in than you can a 90-10. But just to satisfy yourself, maybe it looks like you got a little bit more, but how much more are you going to have? Is it 2%, 3%, 4% more cash value? What are you giving up in the later years for that little 2, 3, or 4% in those early years? Well, it's kind of just like, you got to decide what's more important, because the give is not worth the take.
I love it.
Or the take is not worth the give, however you say that.
I want to give a little shout out to Dallas Sullivan. I got my first policy. Thanks, Carson, for your help. Love that.
Brandon's my guy too. This next comment, guys, we're gonna pull this question up there real quick. Actually,
Brandon, this one.
Yes, he's awesome. I go on Facebook. I'm just scrolling 2 days ago, and I follow him because we're friends now. And he got a policy like last year. He's posting by himself. He's like, "Look at my whole life policy. I'm using it for X, Y, and Z. This is so cool." And like his friends were commenting, like, "Tell me about what you're doing, bro." And I went in the comments and I'm like, I asked Brandon about his stuff, but I was like, "This is so cool." He's posting about it himself. So. Shout out to Brandon for using his policy.
Carson, dude, he's right here. I mean, ask him to come on the podcast, man. Let's get him on the podcast to tell his story. I mean, he's been doing it a year. He's paying down his debts. Like, if he's got a success story, we need to highlight that. And that goes for any one of you on here. If you have a success story, I want you to come on the Money School podcast and tell your story to everybody else. I mean, people just get sick of us telling you our stories. Like, we want you to tell the world your story. So if you've got a story of success, please get a hold of whoever your money mentor is and tell them, I want to take you up on going on Chris's podcast. And hey, listen, like, I'll let you do your own podcast if you want. I can interview, James can interview, Carson can interview. I'm opening my podcast up to every single client. So it's now going to be your podcast as well. Use my podcast, which has got well into the hundreds of thousands of downloads. It's been around for 6 years. I mean, it's a big podcast. Like, put yourself on a pedestal and just use the platform, please, because I want people to know your stories.
There's also a major like spam in the chat, just so you guys know.
It's a scam.
Are they selling
I don't
more
wanna-
Bitcoin?
I don't want to bring it to too much attention, but there is crazy.
Sean, am I giving away Bitcoin again?
No, you're robbing people. You're robbing people of their slavery. You know what I mean? To get to me. Okay. Well, so Brendan, we'll keep going here, but Brendan is saying, I want to take my first loan on my policy to pay off some high credit card debt. And honestly, I think he just really just doesn't know how to do it. So does One America have like a login portal and stuff like that you guys can do?
Yep.
Yeah. So just if you know who your implementation specialist is, just or not, we can find out for you. But schedule time with them, and they'll walk you through how to access your.
And Carson will find out for you, Brendan. This is Carson just acknowledging. Carson will find out, connect you with your implementation specialist. It's super easy. You're just going to policy services, requesting it, making sure you have the right information you need. So it's super simple, and we'll help you get there.
Yeah, you'll never need to contact One America because we have teams that are there for you, so you don't have to call the insurance company. So so Carson, you already know what to do.
Yeah. And it's not that you necessarily would need to call them up either. Honestly, like I have, it's just like my banking is like, I treat an online portal, you know what I mean? So you get a login and all that sort of stuff, and you'll be able to handle it yourself.
And Brendan, I see your implementation specialist is Alyssa, and I see you actually talked with her a couple months ago. So just email her again, ask her to give you the policy loan request form, and she'll get you going.
Perfect. So Tanya's asking again about HELOCs, Joe. If I get a HELOC on my primary residence, can I purchase another house to be my primary residence?
You can use the first lien HELOC to buy your next primary residence.
It's not it.
Okay.
Yep.
We just had a client do exactly that. Joe helped them navigate that and get it set up, and they literally sold one home and purchased their next home with their HELOC. So, and started policies with that as well and paid off debt. So,
and it's actually, I have a client right now that I need to intro you, Joe, to. This person has a lot of debt, just bad debt, but it's under control, but it's still just debt. Their income is DTI is like 100%, but they want to buy a home right now, and they have the ability to buy the home. They have the down payment. And they're saying kind of how do we work with infinite banking? And so it's kind of a cool thing. Like their mind just kind of was like almost not scrambled, but kind of blown away. So they have over 100K cash. They're going to put a bunch of it into a policy, transfer the debt into the policy loan, which then changes their DTI, which then qualifies them for a first lien HELOC to buy their new home. Then they can combine the HELOC with Velocity Banking, and all of a sudden their entire financial situation is going to transform. And they were like, they kind of had a peripheral idea of it, but when I took 3 minutes and said that, and they're like, holy crap, now I understand what you guys are talking about. When you start to combine these things together, all of a sudden, like you can completely change your life from a financial perspective. So they're pretty excited. So, and this has been a client I've been working on for quite some time as well. It's going to be a fun one. So, yeah, the HELOCs are very powerful.
I love that. So just a couple more questions, actually. So Charles is saying, why would you have multiple policies?
It's just like, why are there more branches than one for a bank? So any bank you go to, is there only one branch office that exists? There's not. There's multiple branch offices. And why would that be? Well, because as they expand the branches, they get to raise more money and they get more deposits. So think of your banking system just like their banking system. You're going to start with one branch office, but eventually you're going to max that branch out. You can't take on any more deposits into that branch. Like we were talking earlier, when you want to put more money in, you can't put more money into it because you've hit the MEC limits, the IRS limit. So branch office 1, policy number 1 is maxed out. So what are you going to do? You're going to go open policy number 2. You're going to open branch office number 2. You got to think as if you're the bank. That's why I'm talking in like you're opening branches of banks. But policy number 2, what's the purpose of policy number 2? To take the money that policy number 1 in the infinite banking concepts activity that you're making there has a place to go, because you can't put any more into the first policy. So now you do the second policy to take over and start filling that bucket up. And then you'll max branch office 2 out, and you'll go to 3 and 4 and 5 and 6. And it just keeps going. And eventually you'll start expanding your ecosystem too. You'll do policies on a spouse. You'll do policies on a child, maybe policies on parents. And each one of those policies will be for a different thing, but it all is just to increase the limit of capital you can put through your banking system.
And you'll see over time, like we talk about how it's number one thing in infinite banking is thinking long-term, right? Thinking long-term. So over time, you'll build, like Chris just said, many branch offices. I've heard of people having over 40 plus, right? We have Brent who started the Money Multiplier with 28. So you'll build over time. It's not going to all happen at once, but like Chris said, you're going to want storage for all of your family's wealth. And then you start buying your kids' houses and their kids' houses and cars and everything else stays, all that interest, all that money stays in your family. Is that our last question, Shauna?
No, there's a couple more in there.
Yeah, sorry, I'm on another fire. All right. So Nick is saying, we have been having quite the discussion around the office on life policy that has MEC'd. Are the loans taxable? On a life policy that has MEC'd, are the loans taxable?
From my understanding, they can be, yes.
Yeah, they certainly can be. So I'm just rereading the question.
It's a first in, last out structure, so it's not like a simple, straightforward answer. But bottom line is, when a policy MECs, when you take money out of it in one form or another, it's going to be potentially taxable. But obviously,
yeah, I mean, essentially, think of it like whatever dollars you put in, you can pretty much take out. But there's also a 10% early withdrawal penalty that's going to be. They're going to treat it kind of like they would retirement dollar money, like it's, or like I would say like a non-qualified annuity, if you're familiar with those. The dollars that you take out are subject to potential 10% early withdrawal penalty, and you're also going to have to deal with anything above and beyond your cost basis. That's all going to be taxable. Where now, if I put in $100,000 into a policy and I take $1 million in loans out, that $900,000 is not taxable. Okay, because it's a loan. So when I die, that loan is subtracted from the death benefit, and the death benefit's paid out tax-free. But if it's a MEC, all bets off with that. And not all the tax advantages, but almost all the tax advantages of doing a policy are out the window in a MEC policy. And they did that in 1988, primarily because wealthy individuals, a lot of oil tycoons, they found out about whole life policies and the growth like we talk about every day. So they started dumping millions and billions of dollars into single premium whole life policies. So they put money in one time, and then that money would grow tax-free, potentially tax-free for the rest of their life. And they got to use that plus all the gains. And the IRS is like, whoa, hold on a second. Hence where the MEC 7 pay came in. And that's why there's that rolling 7-year calculation that they're going to do based on premium and death benefit. So the discussion you're having around the office about that, if there's a policy that's a MEC, all single premium policies, unless it's a 1035 exchange, are always going to be a MEC. So if you're dealing with once a MEC, always a MEC. You cannot undo a MEC. Once it's deemed a MEC, you're done. It will always be taxable. So sounds like some interesting discussions.
I was going to say, how cool is that they're talking about it around the office? That's not too common, is it?
I know, it's really cool.
That's really cool.
All right. And then last for right now, we got Oren is saying, after I take my loan and pay down or pay off some debt, the money that I am saving up and putting into the separate account, when should I pay off that loan? Should I let it build up and pay off the loan, then rinse and repeat with extra deposits?
I'm just going to say how I do it, because this is, there's really no right way to do this, Oren. How I do it is when I take a loan out from the policy, let's just say I lend it out on Private Money Club. So then I've got immediate income coming back, going to my segregated account. So I took a loan, I lent it out, I'm earning interest on it. That interest is coming back to the segregated account. I don't let any of that money build up in that segregated account. I immediately set up a loan repayment through the implementation team, and whatever those dollars are in interest that are coming into the segregated account, I put them right back into the policy as a loan repayment. Now, there's two reasons I do that. Number one, I don't like banks. So I don't want the bank having the ability to use any extra money that I don't have to leave there. Secondarily, and more importantly, and we've done trainings about this, so there's lots of YouTube videos I have on this. When I take that money and I put it back into the policy as a loan repayment, I am reducing the loan to the insurance company. So if it, and I'll just keep math simple, if the insurance company is charging me 5% on, let's just say, a loan of 100 grand, but then I pay the loan down to 95 grand. How much is the insurance company charging me 5% on? And then I pay it down the next month to 90 grand. How much is the insurance company charging 5% on? 90, not 100. So every single month that I'm repaying that loan principal, I am reducing the amount of interest I'm actually giving to the insurance company. Insurance company is always going to charge the 5% in this hypothetical example. Okay, they're always going to charge 5%, but we get to choose how much money we pay that interest of 5% on. So by recapturing the money back to the policy as a loan repayment, I'm always bringing that principal down, which means at the end of the year, when the insurance company bills me, because the insurance company only bills interest one time per year. When I get that bill for the interest at the end of the year, if I calculated how much that interest was based on the loan, it's not 5%. And we have calculators that do this, but it would be significantly less because you've been paying interest on a lower declining balance as you're doing that. So your question is, how often should you, take the money and put it back into the policy? My answer would be as much as you can. Use the implementation team, your specialist, to set up loan repayments. And then every time you do a new loan and create more income or have more money to pay down, just increase that. I can't even count how many times I've just made one-time loan repayment back to the policy just because the money was sitting in the bank account. I got a real problem with letting the bank use my money after I learned how banks work and what they do with my money. I don't want them to have that money. So I constantly am trying to get as much as I can back to the policy to repay those loans so that I can use it again.
I love that. I also just set up a repayment, so it's just a monthly repayment. I set it up once. Daryl is saying, has a date and location been set for the PMC event East later this year? Really rough one. We're going back and forth, but it might be November 8th and 9th. I think it's a Friday, or it'll be a Thursday, Friday combination because they have something already that Saturday. So like typically we do a Friday, Saturday, but this time it'll have to be a Thursday, Friday. Let me just scroll forward real quick. Yeah, tentatively, I want to say it's November 7th and 8th in Charlotte, North Carolina. Tentative. We'll confirm shortly. And then last question for today, Pamela is saying, I'm just starting to learn, but I don't qualify for life insurance and neither does my husband. How do I get started?
Linus wants this one, I can tell.
Sure. So my first thought would be on Pamela and her husband. Have they actually applied to make sure that they get declined? If not, that would be a place to start. Otherwise, hey, do you guys have kids? That would be a good place to somebody to take a policy on. Now, there are some limits if you guys don't already have life insurance. You might not be able to get as much on kids as what you want. So then there would be other places to look, like how about your parents and potentially also siblings who may be business partners. Anybody you have an insurable interest on, you can apply to take a policy out on.
I love that. Does it make it easier if they have something that like a formal denial, you know what I mean? Like, so like, let's say they immediately just go and they, like you said, like maybe they think they are, do they need like a little slip or something that basically says that?
No, typically no documentation needed of that. It's just that I would be asking, hey, did you go through underwriting at any insurance company that you actually got declined at, or do you just think of it based on a certain condition that you think you would not qualify?
We get some more information. So Pamela, like we would want to know, like what were the medical conditions? Even if we don't go through the whole process, we can go to preliminary underwriting. Like I just talked to someone who just had open heart surgery. Definitely be declined, but you know, if we were looking for the next insurable interest, we would send it to preliminary underwriting, say, hey, so-and-so just had this or has this medical condition or this medications. And then we would get the feedback. So at least we have it documented. And then as far as adult children, I mean, it would be based on their bodies, their income, their things. You couldn't own the policy on it, but I believe you can fund it and you can actually transfer ownership once the policy is open, if that's something that your children were open to. So there's that potential for them too. Is it, Linus, did you hear anything there that wasn't on point as far as accuracy goes?
No, that's right.
So we rocked another Ask Me Anything with a WTF background. Chris has got I love the new setup, man. You look,
I'm still getting used to it.
Sophisticated. You look sophisticated and comfortable.
It's cool. I mean, there's a lot I can do here. I'm just trying to experiment. It's just trying to figure out like how to get things to talk to one another. And like at first I thought I needed the iPad, but then I could just turn the computer monitor and just read everything from there. I just don't have the eyes that I used to when I was 20 years old.
That's why you saw Connor sneak in and hand me these glasses halfway through because everyone looked fuzzy. I'm like, I need some glasses.
What's so funny, Chris, is it looks like nothing's changed to a viewer, but actually the things behind Chris have moved for like a third or fourth time now. They were a set somewhere else, then they were at the old office, and now they're at the new
that's
office.
where I did Wealth Webinar. And then over there's a whole nother set.
Woo!
And then a whole nother set over there.
Oh my God, look at that place.
There. And then that brings us all full circle to right here.
Love it.
Wow.
It's actually huge too. Honestly, it looks like when you just turn the camera on, it does not do it justice.
Brother, that is cool.
No.
That is cool.
Big.
The cars and the floor and the chandeliers. That is awesome.
Man, when are we meeting for everyone, man? We got to go see it.
We went all out. Well, we do. We have our first event in July. What are the dates for that, Shauna?
I think it's the 25th and the 26th.
Yeah, right before my birthday. Yeah.
Yeah, it's a very, very.
There's only 4 spots left.
Yeah, for sure. But it's the 25th, 26th, and 27th. So a Thursday, Friday, Saturday.
Because we're doing some cool things. It's not going to just be here. We're going to be doing all sorts of stuff from podcasting. We're going to be going out on the jet boats. If anyone knows anything about the Niagara River, it's a wild, powerful river. And there's like a whirlpool and there's class 5 rapids. I mean, no boat can go through these class 5 rapids. They're insane. It's right after the whirlpool, but they got these jet boats that you can take up, and they go up next to the class 5 rapids. They take you up into the whirlpool, like not into it, but like they turn around kind of in it. It's a bit freaky. And then they sit there and they say, are you ready? And then they just floor the jet boat and they literally plow through class 5 rapids. The whole boat submerges and goes completely underwater and pops back out. You think you're going to die, but then you don't. And it's pretty sweet. So we're going to do that.
I'm scared.
I saw that in your energy.
Swimming upstream. Hilarious. So yeah, actually David and Dorothy just asked about that. I think that's not necessarily a PMC event, but Nogglesphere, as we call it sometimes. And then real quick, Charles, any details on nieces or nephews?
I've helped people get policies on their niece and nephew, so it's going to be based on their parents. It's going to be based on their parents' income, their parents' health, how much coverage they have, and reverse engineer that way. And then depending on the family relationship afterwards, you could transfer ownership that way. Like I help another real estate investor do that because he did not have kids of his own, but his wife's niece and nephew, they ended up wanting to help them. They're like family all the time around them, right? Like their own kids, basically. So creatively, it could happen, but we will help you navigate that.
Yep.
Okay, perfect. And just for anybody who needs to book a call with our team to get started or to, talk about any of these possibilities, you go to mentors.beyourownbanker.com and you will talk to likely one of these people on the screen.
Very cool. Well, thanks everybody for joining us for an Ask Me Anything, another Ask Me Anything. We can't wait to see you on the next one. Till then, have a good day.